When it comes to the stock market, history has a strange way of repeating itself. Over the last century, one month has consistently stood out as the most troublesome for investors: September. Whether you're a beginner just starting to invest or someone who's been watching the markets for years, you've probably noticed the pattern. Stock charts dip, headlines scream panic, and portfolios take a hit. But here's the big question: why does this happen? And more importantly, how should you, as an investor, respond to it? If you look back across the last 100 years of market data, you'll find that September has historically delivered weaker returns compared to any other month. Even major financial institutions like J.P. Morgan, Goldman Sachs, and Bloomberg have documented what's known as the September effect. This effect isn't about one bad year or a coincidence, it's a recurring theme. The Dow Jones, the S&P 500, and the Nasdaq have all shown this seasonal weakness in September more times than any other month. Now, this doesn't mean every September brings a devastating crash. Sometimes the losses are mild, sometimes they're more dramatic, but the consistency of the trend makes it worth paying attention to. And if you're serious about building wealth, it's critical to understand whether this is just a superstition or a real opportunity. Because while most investors panic and sell during downturns, the smartest investors, think Warren Buffett, Ray Dalio, or Peter Lynch, look at dips as discounts. So in today's video, I'm going to break down 1. Why September has been the worst month for stocks historically. 2. The psychology and financial factors that make this month different. 3. How you should approach investing during these dips. 4. Why a long-term strategy beats short-term panic every time. By the end of this video, you'll not only understand why September often feels like a market nightmare, but you'll also learn how to use these downturns to your advantage. Instead of fearing the dip, you'll know exactly how to prepare and invest smarter when everyone else is panicking. Let's dive in. The September effect isn't a myth or an internet rumor, it's a well-documented financial phenomenon. For over 100 years, September has been the weakest month for stock market performance across major U.S. indices. Data compiled from the Dow Jones Industrial Average, S&P 500, and Nasdaq all tell the same story. When you compare average monthly returns, September consistently ranks at the bottom. According to the Stock Traders Almanac, from 1928 through today, the S&P 500 has averaged a decline of about 1% in September. That may sound small, but when compared to the average gains of other months, it's significant. Imagine earning 1–2% in gains most months, only to have September wipe out the progress. That's why traders and analysts pay so much attention to this month. The September effect has also been visible during some of the most famous downturns in financial history. For example, in 2001, following the 9/11 attacks, the markets plunged in September. In 2008, during the height of the global financial crisis, September saw one of the steepest market drops of the decade. Even in more stable years, like 2015 or 2020, September brought heightened volatility and investor anxiety. It's important to note, however, that the September effect isn't guaranteed. Markets don't crash every September, and in some years, the month even finishes in positive territory. But the probability of losses is higher compared to other months, and that pattern has persisted long enough to earn its reputation. One reason the September effect remains so widely discussed is because it feeds into investor psychology. When traders, institutions, and retail investors all expect September to be bad, their actions can create a self-fulfilling prophecy. More people sell, fewer people buy, and the downward pressure builds momentum. The key takeaway is this: the September effect is real in the sense that the data backs it up, but it's not a certainty. Instead of fearing it, smart investors recognize it as part of the natural rhythm of markets. Understanding this history gives you an edge. When others panic, you know the cycle and can prepare to act. So why does the September effect happen? If markets are supposed to be efficient and forward-looking, why would one month consistently perform worse than the others? The answer lies in a combination of psychological, seasonal, and institutional factors. One major reason is seasonality in investing behavior. Many mutual funds and large institutional investors operate on a fiscal calendar that ends in September. As the quarter closes, they rebalance their portfolios, often selling off underperforming assets. This wave of selling pressure naturally drags down the broader market. Another factor is the return of retail investors after summer. During June, July, and August, trading volumes tend to be lower because many investors, especially in the Northern Hemisphere, were on vacation. When September arrives, activity picks back up. With fresh eyes, many investors reassess their positions, often deciding to cash out before the final quarter. There's also a psychological element known as behavioral bias. Since September already has a reputation for being bad, many traders enter the month cautiously, bracing for declines. This lack of optimism translates into reduced buying activity, which can further push markets downward. Additionally, September has historically been a month of economic uncertainty. After summer, companies begin issuing earnings warnings for the upcoming third quarter. Governments also revisit fiscal policy, budgets, and debt ceilings in September, which can trigger volatility. For instance, debates over government shutdowns or spending bills in the US often flare up in this month. Let's not forget tax strategies. Some investors use September to harvest tax losses, selling losing stocks to offset capital gains elsewhere. While this helps them minimize taxes, it adds even more selling pressure to the market. When you put all these factors together, mutual fund rebalancing, increased trading activity, psychological caution, fiscal deadlines, and tax strategies, you get a perfect storm that explains why September tends to underperform. It's not a curse, it's the result of real financial behaviors converging at the same time each year. Here's the part most investors miss. While the average person panics in September, the smart investor sees opportunity. The greatest fortunes in stock market history were built during downturns, not booms. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." That mindset is crucial during months like September. When the market dips, you have the chance to buy high-quality stocks at discounted prices. Think of it like a seasonal sale. If Apple, Microsoft, or Google suddenly drop 5–10% in September without any change to their fundamentals, that's not a reason to panic, it's a reason to buy. The companies haven't lost their value, but the temporary market fear has made them cheaper. The best strategy during these dips is to focus on fundamentals. Look for companies with strong balance sheets, consistent revenue growth, and sustainable business models. These are the businesses that will not only recover after a downturn but also thrive in the long run. Another smart move is to use dollar cost averaging (DCA). Instead of trying to perfectly time the bottom, commit to investing a fixed amount regularly, weekly or monthly. That way, when September brings lower prices, you naturally buy more shares for the same money. Over time, this strategy smooths out volatility and builds wealth steadily. You can also consider dividend-paying stocks during dips. These provide income even when the market is down, helping offset some of the paper losses in your portfolio. Plus, reinvesting dividends during downturns accelerates your long-term growth. Finally, don't overlook ETFs and index funds. If picking individual stocks feels overwhelming, broad market funds like the S&P 500 ETF SPY or NASDAQ 100 ETF QQQ give you instant diversification. When the entire market dips in September, these funds drop too, but history shows they eventually recover and hit new highs. The bottom line is simple. Downturns like those we often see in September are buying opportunities, not selling signals. If you stay disciplined, ignore the panic headlines, and focus on long-term value, you'll come out ahead. The final and most important lesson is this: the investors who lose money in September aren't the ones who hold steady, they're the ones who panic and sell. Panic selling turns temporary paper losses into permanent real losses. Consider this: if you had invested $10,000 in the S&P 500 in the year 2000 and held on through all the crashes, including the dot-com bubble, the 2008 crisis, and the COVID-19 crash, your money would have grown to over $40,000 by today. But if you had panic sold during any of those downturns, your returns would have been drastically lower. The long-term trend of the stock market is upward. Yes, there are bumps, crashes, and scary headlines, but history shows that markets recover and reach new highs over time. This is why patience is a superpower in investing. A long-term strategy means setting clear goals, building a diversified portfolio, and sticking to your plan no matter what. It also means resisting the urge to constantly check your portfolio during volatile months like September. The more you watch the red numbers, the more likely you are to make emotional decisions. It's also helpful to remember the concept of opportunity cost. If you sell during a downturn, you not only lock in losses but also miss out on the recovery. Markets often rebound quickly after dips, and if you're sitting on the sidelines, you'll miss that growth. The best investors don't try to predict exact highs and lows. Instead, they focus on time in the market, not timing the market. They know that wealth is built over decades, not days or months. That's why September dips, while uncomfortable, are just small bumps on a much larger journey. So when the headlines scream, crash, and everyone around you is panicking, remind yourself, this too shall pass. Stay calm, stick to your plan, and let time do the heavy lifting. The stock market's track record in September might look scary, but it's only part of the story. Yes, the data shows that this month tends to underperform, and yes, the headlines make it sound like the sky is falling. But when you dig deeper, you realize it's not a curse, it's simply the result of seasonal behaviors, institutional rebalancing, and investor psychology. The real winners in the market aren't the ones who avoid dips, they're the ones who use them wisely. If you can stay disciplined, avoid panic, and invest strategically during downturns, September can transform from the worst month of the year into one of the best opportunities to grow your wealth. So as you watch the markets this September, or any volatile month in the future, don't fall into the trap of fear. Remember the history, understand the reasons, and stick to your long-term plan. Use dollar cost averaging, focus on quality companies, and never forget the golden rule: time in the market beats timing the market. At the end of the day, financial freedom doesn't come from avoiding risk, it comes from managing it wisely. And downturns like the September effect are the perfect training ground for learning how to do just that. So next time the markets dip, don't see it as a crisis. See it as an invitation. An invitation to build wealth, to stay disciplined, and to think long-term when everyone else is thinking short-term. That's how true investors win.